Hello students. In the previous session, we already studied about what is dissolution of partnership as well as what is dissolution of partnership firm and the difference between dissolution of partnership and dissolution of partnership firm and also the circumstances or reasons for dissolution of partnership firm as well as accounting treatment. Now, in dissolution of partnership firm, we need to prepare 3 accounts. So, which are those 3 accounts? One is realization account, second one is partners capital accounts, and third one is cash or bank account. So, under dissolution of partnership firm, we need to prepare these 3 accounts: realization account, partners capital account and cash or bank account. Now, let us see what is realization account. Now, what do you mean by dissolution of partnership? Complete closing down of the business. So, when you close the business, what you are supposed to do? In the business, there are assets as well as there are liabilities. So, we need to close all the assets account as well as liabilities account. So, in the process of assets realized and payment of liability, business might get profit or incur losses. So, in order to find out the profit or loss on assets realized on payment of liabilities, we need to prepare the new account called as realization account. In the admission as well as in the retirement, you used to prepare a revaluation account. But there what happened, the values of the assets and liabilities to revalue. But here in the dissolution of partnership, because we are closing the business, so we need to close all the accounts, that is assets account as well as liabilities account. So, when you are closing, what you have to do, whatever assets are there in the business, that we need to sell and liabilities has to be paid. So, during this course, that is when the assets are realized and liabilities are paid, that time partnership firm might gain profit or incur losses. In order to find out that profit or loss, we need to prepare realization account. So, realization account is an account prepared at the time of dissolution of partnership firm in order to find out the profit or loss on sale of assets and liabilities paid. Now, what are the objectives of realization account? So, why we need to prepare the realization account? First reason or first objective, to close all the assets and liabilities account which are appear in the books of the accounts, to close all the assets and liabilities account. Second one is, the main important thing is to find out the profit or loss on sale of assets, that is assets realized and payment of liabilities. So, we need to prepare the realization account. Now, let us see how to prepare the realization. Let us prepare the format of realization account. So, I will explain how to prepare the realization account. Yes. Now, let us see how to prepare the realization account. So, this is the format of realization account. You have 2 sides, debit side as well as credit side, and particulars and rupees column, both this side, one particular column and rupees column. So, the first step when you are preparing the realization account, the first step, transfer all the realizable assets to the debit side. Transfer all the realization assets to the debit side of the realization account. Now, what do you mean by realizable assets? Realizable assets are those assets which can be converted into cash. For example, stock, bills receivable, debtors, etc. This can be converted into cash. So, only those assets which you can convert into cash, that you have to transfer to the debit side of the realization account. Now, except here, which assets you cannot transfer? One is cash, one is bank, and one more is profit and loss account. So, these three assets you cannot transfer, because cash or bank we need to prepare a separate account. Remember one thing, students, in the problem if they give cash, then you need to open a cash account. If they give bank, then you need to open a bank account. So, in the asset side, if there is a cash or bank account, that amount you cannot transfer it to realization account. One reason is because it is already there in the form of realized form, correct? So, and because we have to prepare a separate cash or bank account, there you have to write this amount as a cash and bank amount as a opening balance. The next one is, I told, profit and loss account. This also you cannot transfer, because profit and loss account will be transferred to the partner's capital account. Profit and loss account is nothing but this is an undistributed profit or loss. A profit and loss account given in the balance sheet means it is an undistributed profit or loss, and asset side amount is nothing but loss amount. This is a loss amount. In the partnership firm, whether it is a profit or whether it is loss, it should be distributed among the partners. Now, asset side means it is a loss, because I am giving from the books of the accounts. In the problem they will give a balance sheet. From the balance sheet you need to transfer all the realizable asset to the debit side of realization account, except cash or bank, because we have to open a separate cash or bank account. Then profit and loss account, this is a undistributed loss. Asset side means it is a loss. So, this loss also should be distributed among the partners under partners capital account according to their profit or loss sharing ratio. That is the first step. You need to transfer all the to each realizable assets account. Realizable assets account. That is the first step. Second step, balance sheet consists of what? Assets as well as liabilities. So, we need to transfer, second step, all the external liabilities, that is outsiders liabilities to the credit side of realization account, except there might be some internal liability like capital of the partners, then reserve, then profit and loss account, and partners loan. Except this, all other liabilities you need to transfer to the credit side of realization account. Now, what is external liability? External liability is nothing but outsider liability. For example, bills payable, creditors, bank loan, bank overdraft, or money borrowed from the outsiders. That is called as external liability. So, when you are closing the business, what you are doing? Whatever assets are there, that you need to sell, and whatever the liabilities are there, that you have to pay. The firm need to pay, partners need to pay. Why? When you otherwise what will do? We will just close and you will go, partners will go? No. They need to find out how much assets are there in the business and what are their liabilities. So, from the assets they have to list out which are the assets they can realize. Realize means they can sell. Also, they need to see how much liability they are supposed to pay to the others, that is outsiders. So, that is the second step. Transfer all the external liabilities to the credit side of realization account. So, except I told one is capital, reserve, profit and loss account, and partners. Capital belongs to whom? Partners. So, where we have to record? Under partners capital account as opening balance. Second one is reserve. Reserve is what? Out of the profit, what they will do, this some portion of the money will be kept as a reserve. So, reserve also because it is out of the profit. Whether this money is taken from the outsiders? No, this is the firm's money itself. So, once they get the profit, what the partners has done, they have kept certain portion of the money as a reserve, because future is uncertain. For a unknown liability, to bear unknown contingencies or unknown liabilities, they will keep the reserve. Now, because they are closing the business, so they need to close the reserve account also. So, whatever amount is remaining in the reserve account, that they need to distribute among the partners according to the profit and loss sharing ratio. Second one is profit and loss account. This is also undistributed profit or loss, because it is there in the liabilities side. This is a profit. This profit and loss account is nothing but it is a profit, and this if it is there in the asset side, what it is called? It is loss. Liability side means it is a profit. Again, what you have to do, because it is a profit, who has the right in this? Partners has the right. So, you need to share among the partners according to their profit and loss sharing ratio. So, where you have to record in the partners? Capital account. So, all these three, capital, reserve and profit and loss account, where you have to record under partners capital account. You are not supposed to record under realization account. And next one more I give, partners loan. Partners loan is nothing but money advanced by the partner to the business. Money advanced by the partner to the business. So, advance amount given by the partner to the partnership firm in the form of loan is called as partners loan. In case any partners loan is there given in the balance sheet, that is liability side of the balance sheet, that should be settled by paying the amount to the partner directly. So, this partners loan you have to settle in the last account, that is cash or bank account. So, we need to directly settle the partners loan account by paying the cash to that concerned person who has given loan to the partnership firm. So, that is partners loan. Again, partners loan also you are not supposed to transfer to the realization account. For example, one I will give you. Now, there are three partners A, B and C are there in the problem. Now, in the balance sheet, liability side and asset side is there. Now, for example, liability side, I am explaining about the liability side. Now, liability side, A's loan is given 5,000, then D's loan is given, bank loan is given, D's loan is 10,000, bank loan is 20,000. This is example. And for example, Mrs. B's loan. Mrs. B loan is given 8,000. Now, when I am explaining, I told only partners loan you are not supposed to record under realization account. Other loans you need to transfer. Now, in this example, who are the partner? A, B and C. Now, whose loan is given? A. First, identify according to the problem whether A is a partner. Yes, A is a partner. So, it is called as which loan? Partners loan. It is called as partners loan. Whether you transfer this partners loan to the realization account? No, no transferring this. Now, second one I gave D's loan. According to this problem, who are the partner? A, B and C. Whether D is a partner? No. So, D is who? Outsider. D is an outsider. So, this is outsider's loan, external loan. Whether you have to transfer to realization account? Yes, because D is an outsider. So, outsiders means external liability. So, you need to transfer to realization account. Next, bank loan. Whether bank is a partner here? No. So, again it is a outsider's liability. You need to transfer. Then last one I give Mrs. B's loan. Now, here partners are A, B and C. Now, Mrs. B means partner B's wife. Whether she is a partner here? No. Again she is an outsider. So, it is an external liability. So, this Mrs. B's loan you have to transfer. Now this, in this 4 example, A's loan, D's loan, bank loan and Mrs. B's loan, only A's loan, because A is a partner, whatever amount given by the A, that is called as partner's loan, because he is a partner in the firm. So that you have to settle where? In the cash or bank account. Directly you have to record under cash or bank account. Other are outsiders liability or external liability. Outsider, they are not the part of the business, they are outsiders. So it is called as external liability or outsider liability. This outsider liability you have to transfer to realization account. You need to transfer to the realization account. So hope this part you understood. Only partners liabilities you are not supposed to transfer. Other liabilities, partners loan you are not supposed to transfer. Other loan you have to transfer. That is the second step. Third step, now, so you need to transfer each, second step is each external liabilities account, external liabilities account. Hope you understood the first 2 steps. First step is what I'll repeat again, transfer all the realizable assets to the debit side of the realization account. One thing is what? In order to find out how many assets in the business you can realize, that you can convert into cash. Why you are transferring to asset side? Because asset shows a debit balance. Then second step is you need to transfer all the external liabilities to the credit side in order to see how much money they need to pay to the outsiders. So you have to transfer all the external liabilities to the credit side of the realization account. Now you have listed out how much assets you can sell and how much liabilities you need to pay. So now you have to proceed with selling the assets, because you have listed out how many assets you can sell. Now you have to go to assets realized. Assets realized. Now assets realized means nothing but sold, asset sold. When you are selling asset, what the business will receive? Business will receive cash. Partnership firm will receive cash. Partnership firm will receive cash. So assets realized is the income for the business. Is the income for the business. So assets realized you need to record under credit side by cash or bank account. You have to record under credit side by cash or bank account. Assets realized. Assets realized. Now here entry will be cash or bank account debited to realized account. Why we are not writing here asset account? Actually when you assets realized, what is the entry? Cash or bank account debited to concerned asset account. Whether it is a machinery means machinery, furniture means furniture. But because already we have closed all the assets and liabilities account, because already we have closed all the assets and liabilities account, we cannot transfer that amount to the asset account. Instead of that, we have opened a new account, so that which is that new account, realized account. So you have transferred to the realization account. So entry will be cash or bank account debited to realization account. So realization account is credited by which account? Credited by cash or bank account, that is assets account. Now sometimes in the problem there will be unrecorded assets, means which are not recorded in the balance sheet, means in the balance sheet they will give all the assets. For example, they have given machinery, furniture, building, stock, debtors, etc. So those are called as recorded assets. Now sometimes they will give unrecorded assets realized also. For example, bills receivable is given in the adjustment, it is given assets realized along with the recorded assets. If they give other assets, means which is not recorded in the books of account, that is called as unrecorded assets. That also you have to realize, means you have to record under cash or bank account. Recorded assets as well as unrecorded, both you have to record under cash or bank account. So under cash or bank account you have to mention which are the assets are realized. You have to write one by one, write the amount in the inner column, total it and show it in the outer column, that is assets realized. Sometimes assets might be taken over by the partner. Assets taken over by the partner. Assets taken over by the partner. Assets taken over by the partner. Now, that time instead of writing cash or bank account, we have to write the name of the partner who has taken over the asset. Means instead of selling it to others, here it is given to the partner. So, partner will pay the cash. So, entry will be instead of cash will be partner has paid. So, partner's capital account debited to realization account. We cannot write asset account because already we have closed the assets account. So, entry will be partner's capital account debited to realization account. Again business will receive money from the partner. Asset is given to the partner and from the partner business will receive. So, again it will go to the credit side, income. It is an income. So, instead of writing cash now, what you have to do? We have to write the name of the partner who has taken over the asset. So, assets taken over. Assets taken over. Assets taken over. That is the fourth step. See, the first step you have listed out all the assets. Second step you have listed out all the liabilities. Third step you have to see whatever assets you have listed out, that will be sold. Along with that, sometimes they will give unrecorded asset also, which is not there in the balance sheet. That also you have to record with that one, with the other recorded asset. Then sometimes instead of selling the assets to the outsider, it will be given to the partner. Partner will take the asset, but he will pay the cash. So, here instead of cash or bank, you have to write partner's name who has taken over the asset. That is the fourth step, that is assets taken over. So, now we are done with settling the asset. First you have listed out how many assets are there, realizable asset, which are the assets you can sell. Now, that we have sold, as well as partner has taken over, So, all the assets are settled. Now, what you have to do? Now, you have to settle the liabilities. Now, you need to settle the liabilities. So, what is the how many liabilities are there in the business that you need to pay now? External liabilities to the outsider. So, when you are paying what it is for the business, it is an expense. Paying the liabilities is an expense for the business. So, you need to record under cash. So, actual cash is paid now. Now, fifth step, payment of liabilities. Payment of liabilities. Payment of liabilities. Payment of liabilities. Now, payment of liabilities means outsiders money, whether some creditors or bills payable, bank loan, bank overdraft, etc. That money has to be paid by the firm to the outsider. So, because it is because firm is paying, it is an expense. So, entry will be realization account debited to cash or bank. Realization account debited to cash or bank account. Cash goes out, actual cash is paid, So, cash goes out. If cash is there, cash account, bank is there, bank account. This you have to keep it in mind. This is according to the problem. If cash is given, then everywhere you have to write the cash account. If bank is given in the problem, then everywhere you have to write the bank account. So, payment of liability will go to the debit side. Cash or bank account. Liabilities paid. Liabilities paid. Cash or bank account. Liabilities paid. Sometimes, as the assets also, liabilities will be taken over by the partners. Liabilities taken over by the partner. Instead of firm is paying, partner will taken over by partner. Means partner will pay the liability. Partner will pay the liability. Now, entry is same here only, same like previous one. But instead of writing cash, you have to try the name of the partner now, who has paid the liability. So, entry will be realization account debited to partner's capital account. realization account debited to partners capital account. So, again debit side expense to partners capital account, to partners capital account, to partners capital account, that is liabilities taken over, liabilities taken over, liabilities taken over, liabilities taken over, name of the partner who has taken over the liability, that you have to record. Now, so liabilities to adjustment, liabilities paid by the firm or liabilities taken over by the partner. If it is paid by the firm, then you write cash or bank account. If it is taken over by the partner, then you write to partners capital account. So, that is the difference. If it is paid by the firm, then it is to cash or bank account. If it is paid by the partner or taken over by the partner, then to partners capital account. Next, last step for doing the dissolution of firm, that is partnership firm, for selling the assets as well as payment of liabilities, they need to incur certain expenses called as realization expenses or dissolution expenses. Realization expenses, or it is also called as dissolution expenses. For closing the business and also for selling the assets and liabilities, they need to incur certain expenses called as realization expenses and dissolution expenses. As the name only says, it is an expense. So, firm has to pay the money. Firm has to pay the money. So, here also there are two cases. Sometimes firm will pay. So, that time realization account debited to cash or bank account. Realization account debited to cash or bank account. Sometimes partner will pay the realization expenses or dissolution expenses. That time entry will be realization account debited to partner's name, to partner's capital account. You have to write the name of the partner who has paid the realization or dissolution expenses. So, last entry you have to, last step or last entry you have to pass for realization expenses or dissolution expenses. But here there are two cases. Sometimes realized expenses will be paid or dissolution expenses will be paid by the firm. That time you have to write to cash or bank account. Sometimes it will be paid by the partner. That time you have to write to partner's capital account. So, debit side expense, you have to write dissolution or realized expenses. Expenses means debit side. To, if it is paid by the firm, to cash or bank account. Dissolution expenses. In case if it is paid by the partner, then you have to write the name of the partner, to partner's capital account, to partner's capital account. That is dissolution expenses paid by the partner. Dissolution expenses paid by partner. Dissolution expenses paid by partner. Paid by partner. Dissolution paid by the partner. So, these are the 7 steps we need to follow while preparing the realization account. Step 1, transfer all the realizable assets to the debit side, because asset shows a debit balance. So, you have to record under debit side. Then second step, transfer all the external liability, that is outside liabilities, to the credit side. Liability shows a credit balance, so you have to record under credit side. So, why you have to transfer assets and liability? Assets is transferred in order to see how many assets the firm can sell. Why you have to transfer the external liability? To see how much money they need to pay to the outsiders. Then, now first you need to settle the assets now. You have listed out all the realizable assets. That assets you can adjust in 2 ways. One is it will be assets realized, or it will be given as assets taken over. So, whatever assets you have shown here, for those assets any one adjustment should be there, either assets realized or either assets taken over. In case of any asset, any adjustment is not given, assets realized is also not given or assets taken over is also not given, then you have to say whether that asset is a tangible asset or intangible assets. Tangible assets means you have to realize with the same value, means that is book value which is given in the balance sheet. If it is intangible assets, that means you are not supposed to record, because intangible assets you have to consider it as worthless or value less. So, no recording the intangible assets in case if adjustment is not given. For example, goodwill, patents, trademarks, etc. Balance sheet it is there, but in the adjustment it is not told that that goodwill or patent or trademark is realized or taken over, is both is not given. That time you have to ignore such intangible assets, because you have to assume that intangible assets are valueless or worthless, no recording. In case tangible assets, for example, machinery or furniture or bills receivable, stock, etc. Balance sheet it is given, but adjustment is not there about assets realized and assets taken over. That time you have to record those tangible assets in the assets realized, that is you have to record under cash or bank account at book value only. How much balance sheet value is given, same value you have to record. So, that is assets realized and assets taken over, it will go to the credit side. If it is assets realized means you have to write under cash or bank account. If it is taken or assets taken over by the partner, then you have to write the name of the partner. If A is taken over, then A is capital account. So, assets adjustment is done. Now, liabilities to be paid, see opposite side. Assets is transferred debit side, but whatever adjustment of the assets that you have to record under credit side. Now, liabilities you have recorded credit side, adjustment of liabilities will go to the debit side. So, again liabilities there are two adjustments, either liabilities are paid or liabilities are taken over by the partner. Again both are expense only. So, expense means debit side you record, payment of liability means done by the firm. So, you have to write to cash or bank account. If it is taken over by partner means liability is paid by the partner. So, you have to write the name of the partner, to partners capital account. If B is taken over, then you have to write to B's capital account. Same way, suppose if the liability is paid, value is not given or it is not mentioned at all, liabilities are paid, then firm has to pay the liabilities, external liabilities or outside liability have to be paid by the firm if it is adjustment is not given also. That you have to record under liabilities paid, that is realization account debited to cash or bank account. If it is taken or means, then you have to write the name of the partner. Then the final last adjustment is what? How to record the realization expense or dissolution expense. Realization expenses and dissolution expenses are nothing but for carrying out the dissolution process, that is assets realized and payment of liabilities, the firm need to incur certain expenses called as realization expenses or dissolution expenses. Here also the realization or dissolution expense can be paid by the firm or it will be paid by the partner. If it is paid by the firm, then you have to write to cash or bank account. If it is paid by the partner, then you have to write the name of the partner, to partners capital account. Again it is an expense, so you have to record under debit side. Now, after recording all this information, we need to settle the realization account. You have to balance the realization account. We have to see whether debit side is more or credit side is more, whether debit side total is more or credit side total is more. In case if credit side is more, credit side total is more, then balance you have to record under debit side. The balance in the realization account transferred to the partners capital account, that is the next account. Which is the next account we are going to prepare? Partners capital account. So, you have to record under partners capital account, to partners capital account, and this amount is nothing but profit. This is profit on realization. If credit side is more than the debit side, that is nothing but incomes are more than the expenses. So, it is a profit, and the profit amount you have distribute among who? To partners capital account according to their profit and loss sharing ratio. If it is the other case, if debit side is more than the credit side. That means expenses are more than the income. Then it is called as what? Loss. So, loss also you transfer to which account? Partners capital account. By partners capital account. It is a loss. Whether it is a profit or whether it is a loss, you have to distribute among the partners according to their profit and loss sharing ratio, according to their profit and loss sharing ratio, which is given in the problem. Clear? So, this way you need to prepare the realization account by following the 7 steps. Next, second account is partners capital account. Now, partners capital account you are already studied in the admission of a partner as well as retirement of a partner. Same procedure we have to follow in the dissolution of partnership firm also, but there is slight change that I will tell you. So, first when you are preparing partners capital account, what you will do when you are preparing partners capital account, you need to record the opening balance, that is capital, opening capital balance of the partner, opening capital balance. So, partners capital account, when you are preparing partners capital account, I will take by that 2 partners are there in the business now. 2 partners are there in the business, A and B. A rupees, B rupees, amount in rupees. Particulars, debit side as well as credit side, name of the partner A, amounts are in rupees, second partner is B, amount in rupees. Even credit side also, particulars, A amounts in rupees, B amounts in rupees. First, when you are preparing partners capital account, what you have to record? You have to record the opening capital balance, opening capital balance. Now, capital is what? Part of liability. So, you know the accounting equation, assets is equal to liabilities plus capital. So, you will record liabilities and capital under one side only, liability side. So, because it is liabilities, part of liability shows a credit balance. So, opening balance of capital is recorded under credit side, opening balance, opening balance. In case if debit balance is there, then you have to record under debit side, but most of the time you will get credit balance only, that is capital will be given under liability side. So, your liabilities shows credit balance, so you need to record the capital amount in the credit side. Okay. Now, after recording the opening balance, then you have prepared first account, which is the first account, realization account, and the balance in the realization account you are transferred to partners capital account. You are transferred partners capital account. So, this whether it is a profit or whether it is a loss, which account you are transferred? Partners capital. This we need to transfer to the partners capital account. So, if it is a profit means which side you are recorded here? Debit side, to partners capital account. Now, when you are transferring to partners capital, which side it will go? It will go to the opposite side. It will go to the opposite side, that is credit side, by realization account, by realization account, that is profit on realization, profit on realization. If it is a loss, means which side you have to record? You have to record here you have recorded credit side in the realization account, but when you are transferring to partners capital, it will go to the opposite side. Which side? Debit side, to realization. From which account you are transferring? Realization, to realization account, that is loss on realization, loss on realization. So, profit here debit side, and which account you are transfer? Partners capital. When you transfer to partners capital, it will go to the credit side. From which account you are transferring? Realization. So, you are write by realization account. If it is loss, means which side you are written here? Credit side. So, which account you are transferring to? Partners capital. Here you are written credit side. When you are transferring to partners capital, it will go to the debit side. And write the name of the account from which you are transferred, that is realization account. Now, here I left space. As I told in the beginning, partner's capital account sometimes shows a credit balance, sometimes shows a debit balance. So, credit balance means credit side by balance point, debit balance means you have to record on debit side. But remember, in the problem you won't get such case, that is opening debit balance, always you will get a credit balance only. This is only for your understanding. In case capital account shows a debit balance, then you have to record the opening balance and the debit side, two balance brought down. In case if it is given in the credit side, then it is a credit balance, so you have to record under credit side. So that is the opening balance. Then you need to transfer the first account balance, that is profit or loss. Profit on realization account means credit side, loss on realization account means debit side. Then in the balance sheet, in the problem balance sheet they will give, there are some information like along with the capital there will be reserve as well as there will be undistributed profit or loss. Now reserve will be there under liability side of the balance sheet, general reserve or reserve fund they will give. So reserve means what? Out of the profit, certain portion of the money will kept as a reserve for the future purpose, because future is uncertain, you may not know what will happen in the future. So in case in the future some liabilities or contingencies arises, this money, whatever money they have kept as reserve, they can utilize this. And it is a profit means it will be there under part of the profit, so it will be there under liability side. So liabilities shows which balance? Credit balance. So you need to transfer to which side? Credit side by reserve account, and you need to distribute among the partners. This reserve amount you need to distribute among the partners according to their profit and loss sharing ratio. Reserve amount you need to distribute among the partners according to their profit and loss sharing ratio. For example, reserve is 10,000, then ratio A and B is 3:2. You need to distribute according to 3:2 ratio. 3 by 5 and 2 by 5. That means 6,000 and 4,000. 6,000 and 4,000. Then next one I told profit and loss. In case profit and loss account is given in the balance sheet, that also you have to distribute among the partners according to their profit and loss sharing ratio. If profit and loss account is given under liability side, then it is an undistributed profit which is not distributed. So now because you are closing the business, you have to distribute among the partners. Liabilities means which balance it is? Credit balance. So which account? Credit side, because it is a profit. So by profit and loss, you have to distribute among credit side by profit and loss account. Again distribute according to the profit or loss sharing ratio. Among the partners you have to distribute according to the profit and loss sharing ratio. If it is given in the asset side, if profit and loss account is given under asset side of balance sheet, then it is called as undistributed loss. So now again your loss also you have to distribute among the partner, because if it is a profit or if it is loss, who has to bear? Loss also should be borne by the partners itself. So to profit and loss account, to profit and loss account, that is loss, it is undistributed loss. Loss also you have to distribute among the partners according to their profit and loss sharing ratio, according to their profit and loss sharing ratio. Now other than this, sometimes as I told when I explained the realized account, there are assets taken over by the partner as well as liabilities taken over by the partner. So if it is assets taken over, you will write the name of the partner under realization account. Which side you will record? Credit side of realization. You are written as by partners capital account. And this information, because it is relating to the partners, so you need to record under partners capital account. Assets taken over, entry is what? Partners capital account debited to realization account. So realization account is credited by partners capital account, you are written under realized account. Now this information you need to transfer to the partners capital account. Here which side it is there? Credit side. When you are transferring to which side, it will go debit side. That is partners capital account debited to realization account. Entry is what? Partners capital account debited to realization account. Write the name which partner has taken over the assets, under his column you need to write the amount. Next one, liabilities taken over. What is the journal entry for liabilities taken over? Realization account debited to partners capital account. So, you are recorded in a debit side of realization account. Now, this you need to transfer to partners capital account. Here which side it is there? Debit side. When you are transferring, which side it will go? Credit side. By realization account. By realization account. So, partners capital account is credited by realization account. Credited by realization account. Credited by realization account. Credited by realization account. So, after recording all this information, you need to settle the partners capital account. You need to settle the partners, you need to total it, and you have to see whether debit side is more or credit side is more. So, if debit side is less and credit side is more, that means if credit side is more than the debit side, credit side, then it is a surplus balance. If credit side total of the partners capital account is more than the debit side, means partners capital account shows a surplus balance, means partner has to receive the account. Now, here you have to be very careful. In the admission and retirement of a partner, how you used to settle the partners capital account? By transferring balance to balance carried down. You have to write balance amount, you used to write it as to balance carried down. Now, here what you are doing? Here we are closing the business of the partnership. We are closing the business of the partnership. So, we need to close the accounts of the partners also. We need to close the account of the partners. So, we cannot write it as to balance carried on. How to settle the account? By paying them cash. So, you have to write it as to cash or bank account. So, how you have to settle the account of the partner? By paying the cash. If cash is there, cash account. If bank is there, bank account. This is nothing but surplus amount, means partner will receive surplus amount. Partner will receive. In case if debit side is more than the credit side, if in case debit side is more than the credit side, then partner's capital account shows a deficit balance, means partner has to pay the amount. So, balance also you have to write under credit side. Debit side is more than the credit side, means balance will go to the credit side. That means this is a deficit balance, means partner has to pay the amount. Partner has to pay the amount to the firm. This amount, if you write debit side balance, then it means partner's capital account shows a surplus balance. Credit balance means surplus balance. So, partner will receive money from the firm. In case if it is debit balance, then it is a deficit balance, means partner's capital account shows a minus balance, means partner has to pay the amount to the firm. So, partner's capital account will be settled by transferring the amount to cash or bank account, by transferring the amount to cash or bank account. So, no writing to balance carried on, because we are closing the business, we need to close the account of partners. So, partners capital account also will be closed by transferring the amount to cash or bank account. Then finally, third account we have to prepare is cash or bank account. Here you might have one doubt. In the admission and retirement, we used to prepare balance sheet at the end of the year, correct? But in the dissolution of partnership firm, we are not preparing balance sheet. Why? One reason, we are closing the business. Because we are closing the business, we have already closed all the assets and as well as all the liabilities. Means whatever assets are there that we have realized and whatever liabilities are there we have paid. So, there is no assets and no liabilities. So, when you are closing the balance, we cannot prepare the balance sheet, because we have closed all the accounts of assets as well as liabilities. So, there is no assets as well as there is no liabilities in the balance sheet. So, instead of balance sheet, we have to prepare cash account or bank account, depending upon the problem. Now, why we have to prepare cash or bank account? cash or bank account is prepared in order to see how much cash is received and how much cash is paid. How much cash is received and how much cash is paid. So, when you are preparing cash or bank account, first you have to start with the opening balance. Cash or bank, both are what? Asset. Asset means asset always shows which balance? Debit balance. So, opening balance of cash or bank, you have to record under which side? Debit side. So, you have to write to balance brought down. Always cash or bank account opening balance, you have to write it as to balance brought down. Then, from the realization account and from the partners capital account, all the cash information you need to transfer to the cash account. For example, come to realization account now. Here you have written cash or bank account for what? Liabilities paid. For liabilities paid. So, this information we have to transfer to the cash account. Here we said you have written debit side. When you transfer to the cash or bank account, where it will go? Opposite side means credit side. You have to write by realization. From which account you are transferring? Realization account. So, you have to write by realization account, that is liabilities paid. Then one more is there, cash or bank account, that is for dissolution expenses. Again, this is the information relating to cash or bank. So, we need to transfer to the cash or bank account. Which side you transfer? Here debit side is there. When you transfer to cash or bank account, which side you transfer? Opposite, that is credit side. And you write what? By realization account, that is dissolution or realization expenses. Then come to the credit side of realization. Is there any cash here? Yes. This is for what? Assets realized. Again, this information also you transfer to the cash or bank account. Here in this realized account, which side you have written? Credit side. So, when you are transferring to cash or bank account, which side it will go? Debit side. Which side it will go? Debit side. What you write? To realization account. Which side you write? To realization account. Then one more adjustment you have to do in the cash or bank account, that is partners loan. You need to settle the partners loan. You need to settle the partners loan. Partners loan always there under liability side, always will be given under loan is a liability. So, you have to record under credit side of cash or bank account. You have to settle the partners loan by giving money to the partner under credit side by partners loan account. If A's loan means by A's loan account. If B's loan means by B's loan account. You have to record under credit side. Then finally, you have to transfer the balance of partners capital account. See here in the balance of partners capital account, you have transferred which account? Cash or bank account. Whether it is a surplus or whether it is a deficit, where you have transferred partners capital account. So, you have transferred to cash or bank account. Now, this information also you need to transfer to the cash or bank account. If it is surplus balance means here which side you have written? Credit, debit side. So, when you are transferring which side you have transfer? Credit side by partners capital account. You have to write name of the partner by A's capital account, by B's capital account. If it is a deficit balance means which side you have written here? Credit side. So, when you are transferring to cash or bank account, which side you have transfer? Debit side. You have to write to partners capital account, that is to A's capital account, to B's capital account. And at the end you need to total the cash or bank account. So, remember how the balance sheet is to tally. Same here also, cash or bank account should tally both the asset side as well as in the cash or bank account there will be debit side as well as credit side, both asset side total as well as liability side total should be equal under cash or bank account. So, these are the three accounts we need to prepare under dissolution of partnership firm, that is realization account, partners capital account and cash or bank account. This is very important, students, for 12 marks, and this is the easiest chapter. If you know to prepare realization account, then you can prepare other two account easily, because partners capital account already you have studied under admission and retirement. Only thing you should remember is that is closing, you have to close the partners capital account by transferring balance to cash or bank account instead of to balance carried down. Then cash or bank account just to transfer the information about the cash to opposite side from the realization account as well as from the partners capital account. So, when you work out the problem, you will understand it better. In the next class, we will start with problem. That time you will understand how to prepare the realization account, partners capital account as well as cash or bank account.